What if I told you that investing $10,000 could generate a steady stream of passive income through dividends? For many, this idea sounds like the key to unlocking financial independence. Dividend investing, when done correctly, offers the opportunity to not only grow your wealth over time, but also generate consistent income. However, achieving a significant milestone like $10,000 in annual dividend income requires a strategic approach, an understanding of the benefits and risks, and a solid grasp of the key factors involved. In this article, we'll dive deep into dividend investing, exploring its advantages, potential risks, and offering actionable advice on how to build a portfolio capable of producing a substantial $10,000 in yearly dividend income. The benefits of dividend investing. Dividend investing holds several unique advantages that make it an attractive strategy for both new and experienced investors. The primary appeal lies in the passive income that dividends provide. Unlike other forms of income, such as wages or interest from bonds, dividends are typically paid out regularly, often quarterly, providing shareholders with a reliable source of cash flow. For retirees or those seeking financial independence, this steady income stream can be a lifeline. Additionally, dividend-paying stocks tend to belong to well-established companies with a proven track record of profitability. These companies are often less volatile than smaller, growth-oriented firms, making them a safer bet for conservative investors. Many dividend stocks also increase their payouts over time, providing a hedge against inflation and increasing your income year after year. Another key benefit of dividend investing is the power of compounding. Reinvesting your dividends by purchasing additional shares can dramatically enhance your long-term returns. This snowball effect allows your portfolio to grow faster than it would through price appreciation alone. Over time, this compounding effect can significantly boost both your capital and the amount of dividend income you receive. The risks of dividend investing. However, dividend investing is not without its risks. One of the biggest concerns is the potential for dividend cuts. Companies can reduce or suspend their dividend payments for various reasons, often during economic downturns or periods of financial stress. This not only reduces your income, but can also lead to a decline in the company's stock price, further impacting your portfolio. Market volatility is another risk to consider. While dividend stocks tend to be more stable than non-dividend paying stocks, they are still subject to the ups and downs of the broader market. Economic recessions, changes in interest rates, or sector-specific challenges can cause stock prices to fall, eroding the value of your investment. Additionally, relying too heavily on dividend-paying stocks in specific sectors can expose you to concentration risk. For example, utilities, consumer staples, and real estate companies are often seen as dividend stalwarts. However, a downturn in any of these sectors could have a significant impact on your portfolio if it's not properly diversified. Lastly, inflation can erode the purchasing power of your dividend income. While many companies increase their dividends over time, not all do so at a pace that keeps up with inflation. If your dividend income remains stagnant while the cost of living rises, the real value of your income diminishes. Popular dividend-focused stocks and ETFs. To generate a substantial amount of dividend income, it's crucial to invest in the right stocks and ETFs. Dividend-focused stocks, especially blue-chip companies, are a reliable option. These are well-established firms with a history of steady earnings and consistent dividend payouts. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble are prime examples of blue-chip stocks that provide stable dividends. For instance, Johnson & Johnson currently offers a dividend yield of around 2.7%, Coca-Cola provides a yield of approximately 3%, and Procter & Gamble delivers a 2.4% yield. These companies are known not only for paying dividends, but for increasing them consistently over time. For those who prefer a diversified approach, dividend-focused ETFs are an excellent option. ETFs like Vanguard Dividend Appreciation ETF (VIG) and iShares Select Dividend ETF (DVY) pool together a wide range of dividend-paying stocks, reducing the impact of any single stock underperforming. VIG, for example, focuses on companies with a history of dividend growth, while DVY targets high-yield dividend stocks. By investing in these ETFs, you can spread your risk across multiple companies and sectors, which is a key component of risk management. The challenge of generating $10,000 in dividend income. Achieving $10,000 in annual dividend income is no small feat. Many investors struggle to generate such a consistent and substantial income stream from their investments. The primary challenge lies in identifying stocks or ETFs with the right balance of dividend yield, payout ratio, and growth potential. To meet this income goal, it's essential to carefully calculate how much capital is required and what yields are achievable within your risk tolerance. To understand the scale of the challenge, consider the concept of dividend yield. Dividend yield is the percentage of a company's stock price that is paid out in dividends annually. For example, a stock priced at $100 that pays a $4 dividend has a yield of 4%. To generate $10,000 in dividend income, you would need a portfolio yielding 4% and valued at $250,000. If your portfolio yields 3%, you would need to invest around $333,333 to reach your $10,000 target. The yield of your portfolio is critical in determining how much capital is required to meet your income goals. Another factor to consider is the payout ratio, which is the percentage of a company's earnings paid out as dividends. Companies with a lower payout ratio typically have more room to grow their dividends over time, whereas companies with high payout ratios may struggle to maintain or increase their dividends, particularly during economic downturns. Strategies for achieving $10,000 in dividend income. To reach your $10,000 dividend income goal, a strategic approach is essential. Start by focusing on high-quality, dividend-paying stocks, or ETFs, with solid financials and a history of increasing dividends. Research companies or funds that consistently grow their dividends, as this can help ensure that your income keeps pace with inflation and increases over time. Diversification is another key strategy. By spreading your investments across various sectors and geographies, you reduce the risk of a dividend cut or underperformance by any single company. This is particularly important for investors who rely on their dividends for income, as it can help stabilize your returns during market downturns. Monitoring your portfolio regularly is also critical. Dividend investing is not a set-it-and-forget-it strategy. Changes in the financial health of a company, shifts in the market, or broader economic trends may impact your portfolio's performance. Regularly reviewing your holdings allows you to rebalance as needed, ensuring that your portfolio remains aligned with your income goals. Reinvesting dividends is another powerful tool for building your portfolio. By reinvesting dividends, you can buy additional shares, which in turn generate more dividends. Over time, this compounding effect can accelerate your portfolio's growth and increase your future income. Conclusion: building a steady stream of passive income, generating a substantial $10,000 in dividend income is achievable with the right strategy and a disciplined approach. Dividend investing offers a powerful way to build wealth while providing a steady income stream, but it requires careful planning, diversification, and ongoing management. By understanding the benefits, risks, and strategies involved, you can craft a portfolio that not only meets your income goals, but also grows over time. Whether you're just starting or are already an experienced investor, dividend-focused stocks and ETFs can play a vital role in your financial plan. By choosing the right investments, reinvesting dividends, and keeping a close eye on your portfolio, you can build a wealth-generating machine that supports your long-term financial goals. If you're serious about generating passive income, now is the time to start researching, investing, and building the foundation for future financial independence.